Welcome back to the podcast, Generate Income by Selling Options. In the previous episode, we discussed Vega, an options Greek, and what it means for option sellers. We are going to move on from the Greeks for now and switch topics to strike selection. Picking the right strike is an important consideration when writing, aka selling, options. So, with that said, let's bring in our hosts, Adam and Isla, to dive into strike selection. And, as a reminder, please subscribe to this podcast channel in order to stay tuned in for upcoming episodes. Adam and Isla, the mic is yours.
All right. Welcome back, everyone, for another deep dive.
Always a pleasure to be here.
Today, we are tackling a topic that I think a lot of people are curious about. How do option sellers actually go about picking their strike prices?
It's a good question. It's really at the heart of a lot of the strategies, right?
Absolutely.
Yeah.
And you've heard about options trading, and I bet many of you listening have probably even, dipped a toe in.
Uh-huh.
But beyond the headlines, really understanding the nuances, like selecting the right strike price.
Yeah.
Well, it can feel like you're navigating a maze sometimes.
It really can.
So today, we're aiming to cut through some of that complexity, especially for those of you who are already kind of familiar with the basics, but want to see how seasoned pros approach these really critical choices.
That's right. This deep dive is all about getting under the hood of that decision-making process for one of the most crucial parts of options trading, picking that strike price.
Yep.
We'll dig into what it is, how it works, and importantly, why the choices you make here are so key to your potential gains and your risks.
Our goal, our mission really, is for you to walk away with a clear picture of how experienced traders think about this, so you can maybe apply some of that thinking to your own financial learning journey. All right, let's unpack this. Where do we start? What is the strike price?
Okay, so for those already in the game, you know this, but it bears repeating. The strike price is simply that agreed-upon price.
The contract price.
Exactly. The predetermined price where you, as the option holder, get the right, but crucially, not the obligation to either buy the underlying asset if it's a call option,
No.
or sell the underlying asset if it's a put option. It's your fixed reference point for the trade.
Set in stone for the life of that contract. And tied right into that is this idea of moneyness. It sounds a bit, I don't know, quirky.
Yeah, the name's a bit different. But the concept is serious business.
Right.
It basically just describes where your strike price sits relative to the current market price of the underlying asset right now.
Okay, so it's a snapshot. What are the main categories then? And why does this relationship matter so much?
Well, the big takeaway with moneyness isn't just the definition, but how it connects directly to the probability versus premium trade-off. You've got three main types.
Okay.
First, in the money, ITM. For a call option, this means the strike price is below the current price.
So it's already got some value built in.
Precisely. Like if stock XYZ is trading at $20 a share, a call option with a $15 strike price, that's ITM. You've got the right to buy cheaper than the current market.
Got it. So an ITM call gives you that immediate intrinsic value if you exercised it right then and there.
Exactly. Then you have at the money, or ATM. This means the strike price is, well, equal or really close to the current market price.
Makes sense.
So sticking with our XYZ stock at $20, a $20 strike call would be ATM, right on the money.
Okay.
And finally, out of the money, OTM. This is where the option strike price is unfavorable compared to the market price.
Less attractive, yeah.
For a call, this means the strike price is above the current stock price. So a $25 strike call on that same XYZ stock trading at $20. That's OTM. You'd be agreeing to buy it for more than it's currently worth on the open market.
That example really lays out the whole spectrum clearly. From $15 ITM, $20 ATM, to $25 OTM for a $20 stock. It shows how just changing that strike changes the option's whole relationship to the market price.
It does.
So how does this moneyness thing affect what we actually pay for these options, the premium?
Right, the cost. What's interesting is how directly moneyness impacts the price. Generally speaking, ATM options are more expensive than OTM options.
Okay, why is that?
It's because they have a higher probability, statistically speaking, of finishing ITM by the time expiration rolls around.
So the market assigns a higher chance of success.
Exactly. That higher likelihood of being profitable, even if just by a little, commands a higher premium. You're essentially paying more for that better chance of the trade working out.
Okay, so understanding the strike price itself and its moneyness, ITM, ATM, OTM, that lays the groundwork. But like you said, that's step one.
Right.
The real challenge, and probably where traders spend most of their brain power, is figuring out which strike price is the right one for their specific trade, their strategy.
Absolutely.
So what are the main things guiding that decision? What factors come into play?
Well, the first one, and you could argue it's the most important, is your market outlook.
What you think the stock or whatever the underlying is actually going to do.
Precisely. What do you expect? Are you super bullish, just, mildly positive, or maybe bearish?
Yeah.
If you think there's a big move coming, say, to the upside, you might look at buying a call option.
Yeah.
Maybe one with a strike that reflects that big expectation.
Uh,
If you only expect a small increase, maybe selling a put option makes more sense. Your outlook really is the compass guiding your initial strike considerations.
okay, outlook is number one. What about the trader themselves? How much does personal risk tolerance play into picking a strike? Seems like someone cautious would choose differently than someone chasing, bigger potential returns.
Oh, hugely important. Your risk tolerance is right up there. More conservative traders. They often lean towards strike prices closer to the current market price.
The ATM ones or maybe slightly ITM?
Exactly, because those generally offer a higher probability of success, even if the potential profit per contract is a bit smaller.
Okay.
Whereas someone may be seeking higher returns or perhaps trading with less capital per trade might look further OTM,
Out of money?
right? Those options cost less upfront, the premium is lower, but they come with inherently higher risk because the stock has to move further just to reach the strike. It's that classic risk-reward balancing act.
Makes sense. And you can't ignore the current market conditions either, right? Like how volatile things are or the overall trend.
Definitely not. Those market conditions heavily sway option premiums. For example, if implied volatility is really high.
Meaning the market expects bigger price swings.
Correct. Then options across the board, calls and puts, ITM, ATM, OTM, they'll all generally be more expensive.
Okay.
And high volatility might actually open up a wider range of potentially viable strike prices for certain strategies. Conversely, if the market's just stuck in a range, not moving much,
Yeah.
then you might favor strategies using narrower strike ranges, or maybe strategies that profit more from time decay rather than price movement.
We've hit outlook, risk tolerance, market conditions.
Hmm.
But when options traders get together, the conversation almost always turns to the Greeks.
Yes, the Greeks.
Can you help us unpack one of the main ones, delta? How does that become a tool for picking strikes?
Yeah, delta is probably the most frequently discussed Greek when it comes to strike selection. Now, technically, delta measures how much an option's price is expected to change for every $1 move in the underlying stock.
It's sensitivity to price changes.
Right, but many experienced traders use delta in another way, too. They interpret it as a sort of probabilistic guide.
A probability guide. How so?
Well, it's not exact, it's more of a rough estimate, but some traders look at delta as an indicator of the probability that an option will expire in the money.
Oh, interesting.
For instance, a call option with a delta of 0.25. Again, it's not a guarantee, but it suggests roughly maybe a 25% chance that the stock price will be above that option's strike price come expiration day.
So it gives you a quick sort of numerical feel for the odds.
Exactly. It's
Yeah.
a handy shortcut for gauging the likelihood associated with different strikes.
That is a powerful way to think about it. And this feels like it leads right into another really critical piece, something that's totally intertwined with the strike price.
Mm.
And that's the time horizon, the expiration date.
Absolutely. You can't really think about strike price in isolation. The expiration date is just as critical.
Why is that? How are they connected?
Because the expiration date defines the time frame you're giving the underlying asset to make the move you need for your trade to be profitable.
Ah, okay. The window of opportunity.
Right. Let's say you expect a really sharp near-term gap move in a stock. Maybe because of earnings or some news. You might choose a very near-term expiration date, maybe just days or a week out, and combine that with an ATM strike price to try and capture that specific quick move.
Gotcha.
But if you have a much longer-term outlook, maybe you think a stock will gradually climb over several months, then you'd likely choose a very different strike price and a much more distant expiration date to match that view. They have to work together.
That makes total sense. Strike and expiration, two sides of the same coin. Okay, let's make this even more concrete. Let's look at strike prices in action with some common strategies. A really popular one, especially for people who own stock, is the covered call.
Yes, very common income strategy.
Can you walk us through that? You own shares, say 100 shares of a stock.
Right. and you simultaneously sell a call option against those shares. The goal is usually to generate some extra income from the premium you collect for selling that call.
Okay, so you get paid up front. What's the catch?
The trade-off is that you cap your potential upside profit on the stock. If the stock price rises above the strike price of the call you sold by expiration,
Uh-huh.
your shares will likely get called away, meaning you'll be obligated to sell them at that strike price.
Hmm.
So you keep the premium, but you miss out on any stock gains above that strike.
Okay, so you sacrifice potential big gains for upfront income. One of the interesting things that this piece brings up is this idea of the Fast and the Furious analogy. It says winning by an inch or a mile.
Ah, yeah, I love that.
How does that, what's the connection to options here?
Well, it's all about the difference in mindset between someone buying an option and someone selling an option.
Okay.
See, if you're buying an option, you want a big price move, right?
Yes.
You want Tesla to go to the moon. You want, Apple to go to zero or whatever it is you're going for. Big price move, the bigger the better.
Yeah.
If you're selling an option, though, you're actually hoping for the opposite. What you're really doing is you're saying, okay, I'm going to make this bet that the price isn't going to move past this point.
Right.
And I'm going to profit from the fact that as time goes on, the option itself decays in value. And if I'm right and the price never crosses that point, well, then I get to keep all the money I made when I sold it.
So it's less about how much the price actually moves and more about just moving in the wrong direction.
Exactly. You don't really care if it moves a little bit against you or a lot. As long as it doesn't go past that strike price,
I see.
you're in the clear. And, the piece even talks about day trading options, where these tiny little price movements, they can be the difference between you making a lot of money or losing a lot of money.
Oh, wow.
And that's a totally different approach
Right.
to this long-term, more like you said, set it and forget it. And it makes you wonder which style really speaks to you, you know?
Hmm.
Are you more of the high speed in and out, or are you more of the, I'm going to sit back and let time do the work for me kind of person?
Yeah, I'm more of a set it and forget it kind of person, I think.
Right.
But let's get back to the idea that option selling can be a neutral market strategy.
Absolutely.
Right. Like, is that really true?
It really is. Think about it. When you're buying options, you're saying, the market has to move in this direction for me to make money. When you're selling, you're actually hoping for the market to either stay flat or maybe even move a little bit against you, as long as it stays within a certain range.
So you could potentially make money even when the market's not doing much at all.
Exactly. You're basically profiting off the decay of the option. That's the idea.
So how do you actually choose the strike price?
That's $1 million question, right? That's
Yeah.
where the art and the science comes in. There's a lot of different factors that can influence your decision. How long until the option expires? How volatile is the underlying asset? Is this Tesla we're talking about, which moves all over the place? Or is this, some slow-moving utility stock? And then, of course, your own personal risk tolerance comes into play, too.
Mhm.
Are you comfortable with the possibility of a big loss? Or are you looking to just, make a little bit of money, but very consistently?
So it's not really a one-size-fits-all kind of thing?
No, not at all. The source mentions this idea of delta. Have you ever heard of that?
I have. I don't really know what it means, but
Basically, it's a way of measuring the probability that an option is going to end up in the money, profitable for the buyer.
okay.
So if you're an option seller, you are generally looking for options with a low delta.
That means there's less of a chance that the buyer is going to make money.
Exactly. And a higher chance that you're going to get to keep that premium.
Right. Okay.
Hmm.
Makes sense.
In selling, it doesn't have to be about just staying neutral.
Okay.
Some people, they might be looking to actually use option selling to target a very specific profit level, whereas others, they might be more focused on managing their potential losses. So it's a very flexible tool.
So there's no single best strike price period.
Right. They stress it depends heavily on your overall market assessment. Are you bullish, neutral, bearish? That might dictate whether you lean towards ITM or OTM strikes.
And your personal risk tolerance.
Absolutely. And also your specific goals for the trade. Like, are you targeting a specific percentage return for the month? Maybe 2-4%. That goal will influence which strike offers the right premium for the risk involved. With the stock around $33.68, a more bullish investor aiming for a higher return, maybe 7% in a month, might choose a further OTM strike, like $35.
Taking more risk for potentially more reward via stock appreciation plus premium.
Right. Whereas a more conservative investor, maybe more focused on protecting their downside or increasing the probability of keeping the stock, might choose a deeper ITM strike, like $32.
Less premium, maybe, but more protection if the stock falls.
Exactly. It offers more downside protection because the strike is already below the current price. The choice totally depends on the individual's outlook and comfort level.
And they also mentioned something interesting if you're trading multiple contracts, like not putting all your eggs in one strike basket.
Yes. Strike diversification. If you're selling, say, 5 covered call contracts, you don't necessarily have to sell all 5 at the exact same strike price.
Uh-huh.
You could maybe sell a couple ATM, 1 or 2 slightly OTM, maybe 1 slightly ITM. By choosing a mix of strikes, you can diversify your risk profile across different probabilities, especially if you're a bit uncertain about the market's exact direction.
That's a smart way to manage risk within the strategy itself.
And that brings us perfectly, like you said earlier, to the other absolutely critical decision, selecting the expiration date.
Yeah, you can't choose a strike without thinking about how much time you're giving the trade.
Exactly. Choosing the expiration period, whether it's days, weeks, months, even years out, is just as vital as picking the strike. It defines that window for the underlying asset to do what you need it to do.
And time itself has value in options, right? That's time decay or theta.
Right. All else being equal, an option loses value simply as time passes, and it gets closer to its expiration date. This is known as time decay, measured by the Greek letter theta.
So the clock is always ticking.
It is, and that decay isn't linear. It generally accelerates as expiration gets closer. Shorter-term options decay faster, which is why option sellers often favor shorter durations. They want that time value to erode quickly.
Makes sense.
Yeah.
And what about implied volatility? How does that tie into expiration choice?
Well, implied volatility is the market's forecast of how much the underlying asset's price is likely to move in the future.
The expectation of future choppiness.
Kind of, yeah. Higher 4E generally means higher option premiums across the board for all strikes and expirations because there's more uncertainty priced in. And longer expiration periods naturally incorporate more potential time for things to happen, more uncertainty, more potential volatility shifts. So longer dated options typically have higher premiums than shorter dated ones, partly due to this volatility component and partly just due to having more time value.
So you're juggling strike, time, volatility expectations. Quite a bit to consider. Fidelity had some good points on aligning the expiration choice with not just your outlook, but also how much time you can actually commit to managing the trade.
That's a really practical point. They break it down nicely.
Yeah.
If you're looking at short-term options, say expiring in 60 days or less, these often have the highest theta, the fastest time decay per day. That can offer attractive potential returns, especially for sellers. But they usually require considerable time and attention.
More active monitoring and management.
Exactly. You need to be watching them closely. So they're often better suited for more active, frequent traders who have that time to dedicate.
Okay. What about longer horizons?
If you look at intermediate term options, maybe those expiring in, say, 90 days out to 6 months,
Okay.
these can still provide decent income potential, particularly for selling strategies, but generally require less frequent monitoring and adjustment compared to the short-term ones.
So maybe better for investors who can't be glued to their screens all day.
Potentially, yes. They offer a balance. And of course, you have even shorter-term options, the weeklies that expire every week, demanding even more attention. And at the other extreme, you have LEPs.
Long-term options, right? Expiring a year or more out.
Right. Long-term equity anticipation securities, those are used for very different, much longer-term strategies, often as stock substitutes. So there's a whole spectrum of expirations available to match different outlooks and time commitments.
So we've talked a lot from the perspective of someone perhaps buying an option or structuring a spread. What about the pure options seller? Someone whose main goal is just to collect premium and have the option expire worthless. Is their mindset on strike selection different?
It often is, yes. For what you might call a purist option seller, maybe someone consistently selling OTM puts or calls or iron condors with the intention of holding close to expiration. Their primary goal when picking a strike isn't necessarily predicting where the stock will go. It's more about picking a strike where they believe the stock is highly unlikely to go by expiration.
So it's a game of avoidance. Picking the price level you think won't be touched.
In many ways, yes. It's about identifying areas on the price chart, defined by strike prices, that seem improbable for the underlying to reach within the chosen time frame. They want to sell options that have a high probability of expiring worthless.
That really shifts the focus. Less about pinpointing the destination and more about identifying the unlikely paths.
Exactly. This is why option selling can be such a powerful strategy in neutral or range-bound markets. You don't necessarily need the market to move dramatically in your favor or even move at all sometimes.
You just need it not to move dramatically against you past your short strike.
Precisely. You're often betting against a specific outcome happening. And as one of our sources nicely put it, for sellers holding to expiration, the profit from the premium collected is the same, whether the option expires worthless by just a penny or by $10.
Right. A win is still a win. If it expires OTM, you keep the full credit.
Exactly. Whether by an inch or a mile, the goal is achieved.
Wow, okay. This has been a really comprehensive look. We've definitely peeled back some layers on how strike price selection works in options trading,
Yeah, we covered quite a bit.
showing how things like your market outlook, your personal tolerance for risk, and your chosen time horizon all feed into making these informed decisions. It really highlights that it's about understanding the nuances, not just the absolute basics.
Absolutely. And just to quickly recap some key takeaways. First, remember that strike price selection is truly a fundamental decision. It directly shapes the risk and reward potential of literally any options trade you make.
Can't overstate that. And second, that concept of moneyness, ITM, ATM, OTM, defined by the strike price relative to the current stock price. It's crucial for understanding an option's characteristics and generally its cost.
Right, with ATM options typically being the most expensive due to that higher perceived probability of finishing ITM.
And third, using scenario analysis.
Crucial. It helps you really visualize and understand the potential risks and rewards tied to choosing different strike prices before you put your capital on the line.
Definitely.
And finally, never forget that strike price and expiration date are inextricably linked. They're two sides of the same strategic coin.
Yeah, you have to consider them together.
Both must be carefully thought through and aligned with your market view, your risk comfort level, and whatever your specific profit objective is for that particular trade.
So as you, our listeners, think about how all these factors, outlook, risk, time, probability, influence options trading, and specifically how you choose strike prices. So it's not just about predicting the market, like we said.
Yeah.
It's more about understanding the probabilities and then picking strike prices that help you achieve your goals.
Yeah, I think that's a great way to sum it up. And, it's a journey, right?
Yeah.
It takes time to really learn the ins and outs of option selling.
And that concludes our podcast on strike selection. Thank you, Adam and Isla. If you enjoyed the podcast and found the content helpful, then please like and subscribe to this channel. And if you are on X, then please follow us. Our handle is Selling for Premium. That is selling the number 4 premium, all one word. Thanks for listening.